Welcome back students. Today we will continue the remaining topics of chapter 3. So let's begin. Central Bank. Meaning of Central Bank. The central bank is the apex institution of monetary and financial system of a country. It makes monetary policy of the country in public interest. It manages, supervises and facilitates the banking system of the country. Next, distinction between central bank and commercial bank. Central bank is the apex financial institution of the country that is concerned with formation of monetary policies and the way money should be regulated in the economy. But commercial bank is a type of financial institution that is concerned with providing banking service to the general public and businesses by facilitating deposits, offering loan facilities. Central bank is always having public ownership, but commercial banks can be either public or private in their ownership. There is only one central bank in a country, but there can be many commercial banks in a country. Central bank does not operate for making profit, but commercial banks operate with the motive of earning profit. Central banks create monetary policy to regulate interest rates in an economy. But commercial banks do not create any policies that are essential for the finance functioning of an economy. Central banks are the source of money supply in an economy, but commercial banks run on the deposit obtained from the individual and hence they perform no such functions. Next, functions of central bank. The major functions of central bank are issue of currency, banker, fiscal agent and advisor to the government, banker to the banks, lender of the last resort, cleaning house functions, supervisions of the banks, custodians of nations' foreign exchange reserves. So point number 1 is issue of currency. The central bank is given the sole monopoly of issuing currency in order to control over volume of currency and credit. These notes circulate throughout the secure country as legal tender money. The main reason for giving the monopoly right of note issue of the central bank are: it brings uniformity to note issue, it is easier to control credit when there is a single agency of note issue, it keeps the public faith in the paper currency, it helps in the stabilizations of the internal and external value of the currency. Point number 2. Banker, fiscal agent and advisor to the government. Central bank everywhere in the world act as banker, fiscal agent and advisor to its respective government. As banker to the government, both central and state government, it performs the following functions. It accepts receipts and makes payments on behalf of the government. It also advances short-term loans to the government. As fiscal agent, central bank performs the following functions. It manages the public debit. It collects taxes and other payments on behalf of the government. It buys and sells government securities, treasury bills on behalf of the government. As advisor, central bank acts as the advisor to the government. It, after examining the situation in the market, advises the government what kind of fiscal policy should be followed. Point number 3. Banker to the banks. The central bank has the same relationship with the commercial bank as the latter has with the general public. As the banker bank and the central bank perform several functions, commercial banks are required to keep a part of their net total deposits with the central bank in the form of cash. Point number 4. Lender of the last resort. When commercial banks fail to meet their financial requirements from the other sources, they can approach the central bank which give loans and advances as lender of the last resort. The rate at which the central bank advances loans to commercial bank is known as bank rate. Point number 5. Cleaning house functions. As the custodian of the cash reserves of the commercial bank, the central bank acts as the clearing house for this bank. Since all banks have their accounts with the central bank can easily settle the claims of various banks against each other simply by book entries of transfers from and to their account. So this method is called as a clearing house functions of the central bank. Point number 6. Supervisions of the banks. The central bank supervises, regulates and controls the commercial banks. Point number 7. Custodians of nations' foreign exchange reserves. Another important function of the central bank is that it is the custodians of foreign exchange reserve of the country. Next, controller of money supply and credit. The methods which are generally used by the central bank are broadly grouped into as quantitative method and qualitative method. Quantitative method, it includes bank rate policy, open market operations, cash reserve ratio and by varying the SLR. So point number 1 is bank rate policy. Bank rate policy is the rate of interest at which central bank lends to commercial bank. Clearly, by raising the bank rate, central bank raises the cost of borrowing. This forces the commercial bank to raise in turn the rate of interest from the public. As lending rate rises, demand for loans for investment and other purpose falls. Thus, increase in bank rate by central bank adversely affects credit creations by commercial bank. A decrease in bank's rate will have opposite effect. Point number 2. Open market operations. This refers to buying and selling of government securities by central bank. This is done to influence the money supply in the country. The sale of government securities to the commercial bank means flow of money into central bank, which reduces cash reserves with the banks. With the result, credit availability of commercial banks is controlled. Point number 4. Cash reserve ratio. It refers to the minimum percentage of bank's total deposit which it is required to keep with the central bank. Point number 4. By varying the SLR. The SLR requires the bank to maintain a specified percentage of their net total demand and time liabilities in the form of designated liquid assets which may be excess reserves and current account balance with other bank. And other method is qualitative methods, and it include regulation of margin requirements, moral suasions, selective credit controls and direct action. So point number 1 is regulation of margin requirements. Business and traders get credit from commercial bank against the security of their goods. Bank never give credit equal to the full value of the security. It always pay less value than the security. So the difference between the value of security and the value of loan is called marginal requirement. Point number 2 is moral suasion. It implies persuasion, requests, informal suggestions, advice and appeal by the central bank to commercial bank to cooperate with general monetary policy of the central bank. Point number 3 is selective credit controls. In this method, the central bank can give directions to the commercial bank not to give credit for certain purposes or to give more credit for particular purposes or to the priority sectors. Point number 4. Direct action. Direct action refers to all the controls and directions which a central bank may enforce on commercial banks to regulate their lending and investment activities. Direct action may include the following measures: to refuse rediscounting of bills of the commercial banks, to refuse loans, to impose monetary penalties, to de-recognitions of a commercial bank, to disallow bank to conduct banking business. Next, recent reforms in banking sector in India. In August 1991, Committee on Financial Sector Reform under the chairmanship of M. Narasimhan was appointed by the Government of India. The several reforms in the banking sector initiated since 1991 are: point number 1, shift in the role of RBI. The banking financial sector in India is controlled by the Reserve Bank of India, that is RBI. It is controlled through norms and regulation of the RBI. The RBI decides the amount of money that a bank keeps with them. One of the major aims of the financial sector reform is to reduce the role of RBI. Point number 2. Reduction in statutory liquidity ratio. An important banking system reform has been the reduction in statutory liquidity ratio and the cash reserve ratio so that more bank credit is made available to industry, trade and agriculture. Point number 3. Capital adequacy norm. Adopting capital adequacy norm is also known as capital to risk assets ratio. Point number 4. Access to capital market. The Government of India has permitted nationalized bank to get capital by public issues by going to the capital market by amending Banking Companies Act. Point number 5. Introduction of NPA norms. The Reserve Bank has fixed some NPA norms for scheduled commercial bank so that non-performing assets may be recovered. Point number 6. Entry of private sector banks. After nationalization of 14 large banks in 1969, no bank had been allowed to be set up in the private sector. On January 22, 1993, the Reserve Bank issues guidelines for entry of new banks of private sector in banking business. Point number 7. Modernization of banks. Banking system has also been modernized. With the help of information technology, service delivery has been made convenient both for the customers and bankers. So students, with these topics, chapter 3 ends.